You may have heard about the magic wonders of a tax-free retirement. I'm going to today talk about why that may not be the best strategy for you. Derek Mazzarella with Gateway Financial Partners. I'm a certified financial planner. Let's get after it and kind of talk about why that might not be the best case for you. All right. So the concept basically is I'm going to pay taxes today, saving these investment vehicles that grow tax-free and that can be taken out tax-free. So some of those vehicles are like a Roth, so Roth 401k, Roth IRA. Some of those are things like municipal bond interest, that is tax-free. Health savings accounts fall in this category. And the third one, not as many people use, but you may be seen sold a lot, like permanent life insurance. But also you can use loans from your house. So loans from life insurance, loans from the house, loans from your own securities. So those are things that you can actually take from your assets, borrow against it, and you pay no taxes on the loans. So here's kind of a little bit summary of why that may not make the most sense for you. So this is a hypothetical client that we have here. This looks at their tax rates now in their working years, which is up here, and their retirement years, which is down here. Now you may notice like, hey, what's this? I thought this was a tax-free retirement. What you're looking at here is basically taxes on Social Security benefits. So if you're making a halfway decent salary, it's more likely than not that you're going to have to pay some taxes on Social Security benefits, just because they're usually taxed at 0, 50, or 85% of your benefits. That just means that if you make over a certain amount, and generally the amount's very low, now it's like under $40,000 for an individual to pay taxes on it. So that's one thing to be aware of. And then number two is you're really paying a lot up front, and you're not using any of this time to reduce your taxes while you're working, which is a much higher tax bracket than down here, as you can see. So what's an alternative strategy that we can look at that would make some sense? So this is what kind of a tax efficient retirement could look like. And what I did is instead of putting all of our money into a Roth, we'll break it up, put some money in Roth and put some money in a traditional 401k plan. It drops this down, as you see, a little bit, not earth shattering amount here, and increases this amount here. You said, well, this doesn't look more efficient. But one of the things that we can do is really leverage this valley here. And we can do Roth conversions. So we can take some of the traditional money that we're saving, let's say 20 or 24% taxes on now, we're deferring, and then say, hey, look, we'll pay taxes at a lower rate. So let's take a look at what that could look like in practice and see kind of how we're doing that. So we do calibration. Let's say we go up to the 10% bracket here. Refresh that. Okay, now by comparison, here's what we're doing. So federal taxes paid. So basically, we would pay some taxes in this little area. That's what this green section is. And then you'll see this darker line, this lighter line. This is what we would have paid for taxes had we not converted it, and this is what we're paying now. So all total in this hypothetical scenario, you're paying $34,000 less in taxes potentially moving forward just by having a more dynamic strategy. Now I can play around with the numbers to have it, be a little bit higher and all that stuff. But the point is, leaning all into one tax bracket earlier on is generally not the best strategy. And you really want to figure out what's the right mix of paying taxes now versus paying taxes later, and what can I do in retirement to be more tax efficient in general. So it's not always a one size fits all. The tax-free retirement thing is, in my opinion, is probably not the best for you. That could vary depending on your situation, but I'd more likely have a lot of tax levers to pull because you're going to end up paying taxes either more earlier on or later on, depending on if you're really leaning to either just one strategy or the other one. So Derek Mazzarella with Gateway Financial Partners. If you like the video, please check us out some more.